Welcome to the daily update, where I'll go over the action in the market for Tuesday, September 24th, and then we'll see how things look for Wednesday, September 25th. Pretty quiet day, Monday and Tuesday. We didn't see a big decline to the downside. We're looking still pretty positive in the short, intermediate, and long term. So the Hindenburg almond that's in the background, the weak seasonality that's in the background, those have not developed yet. And that's what we do. We wait for confirmation of the charts. We don't try to front run these things because it doesn't always happen that way. Now, the percentage is that we should have a decline at some point, but until we see that with our charts, we still go with what our charts are telling us. Before I get into the video, there's a thing called the SPXInvesting Program. It's up, it's going. For right now, it's free. It won't always be free, but if you want to check that out, there are additional videos that I post there. There is a link to the website and more about the program in the description below this video. You also get early access to the daily and weekly videos. The daily video is the real hub of the analysis that I do with all of the videos around the outside. Those are weekly videos. They're meant to tie into the daily videos. Okay, so let's go back and talk about what happened and then look at some charts. We did have a higher open and prices rose up to R1 at 57.28. Then we declined down below the unchanged level, the daily pivot at 57.16. We got down to S1 at 57.07. That's interesting. When we got all the way down to 5,700, this is a round number, and that acted as support in Tuesday's session. Then we rebounded back above that. We got back above S1, the daily pivot, the unchanged level, and we climbed back above R1. We then chopped sideways once we got back up to R1, and then we closed slightly above R1. We were up 0.25% on slightly below average volume. There's not a real conviction now between buyers or sellers. And so the market is just kind of maintaining these levels. This is helping our charts to stay positive for the time being. It's also helping some indicators that we've been concerned about to show a little bit of an improvement. But until those things actually play out, we still go with what our charts are telling us until those negative things actually begin to play out, which could happen at any time. And we are positive in the short, intermediate, and long term. Inflation seems to be under control. Interest rates seem to be more stock friendly for the time being. And we're keeping an eye on things geopolitically, especially there appears to be an escalation of hostilities between Israel and Hezbollah, which is in Lebanon, which is a little personally concerning right now because I happen to be in Israel for the time being. Okay, so some comments. We did set another new all-time high with both the S&P and the Dow. We're wondering, is FOMO kicking into gear? Doesn't really seem to be playing out right now. When the folks that don't necessarily follow the market all the time, they have this fear of missing out. They see the market going up, they jump in. That ends up being the top. We really haven't seen all of that too much, at least in Monday and Tuesday session. And then there was some positive news. Now, the different briefings that I read to come up with these bullet points really focused on China, which China doesn't have a major impact on the U.S. economy or the U.S. stock market. It does because so many companies do business with China. But as far as impacting the stock market, China does have a stock market, but I usually don't really pay attention to that all that much. But some of the news coming out of China helped some U.S. stocks that do business in China. We do have a confirmed Hindenburg almond that was generated on 9/12 and a period of weak seasonality. Neither one of those seem to matter to this point, but that could change at any time. On a short-term basis, we are looking, you could say, either extreme positive or showing good short-term momentum. Even though we had an incremental up move on Monday and Tuesday, we're not really busting to the upside. But our short-term indicators, the Stochk RSI, the Williams percent R, the CCI 20, and the 14 has dropped off. And I have to turn on my laser pointer here so that you can see things a little bit better. And I'm not going to go back and start recording again. And the slope oscillator, we are showing positive momentum across all time frames. There's a line that I put on the chart. We're starting to get extreme there. And I'll show you all these charts. The boom indicator based on 20 periods, we're still kind of far away from the 20-period moving average. The stochastics, and then another new addition is the short-term RSI based on 9 periods. In the intermediate term, we have the CMB composite, the 50-period moving average based on the S&P. PMO studies, that's a new addition to the list. The Sean trend meter is extreme, the bullish percent index for the S&P, and then a longer kind of intermediate to somewhat long-term indicator, a 10-period new highs, new lows for the S&P 500. And we're still looking rather extreme with the 150 and 200 simple moving averages, and then the exponential moving average that's applied just to the S&P 500 itself. The scenario has not changed as of right now. The Fed did cut rates last week, 0.5%, because it looks like this soft landing scenario seems possible. The dollar was up and interest rates were down. We're just kind of floating around that 3.74, 3.73 level with the 10-year yield. So you have to kind of round up or round down to see any changes there. The 10 to the 3 month is still inverted. The 10 to the 2 is back to being uninverted. And I stopped showing those charts for right now unless something changes in that area. We are still positive when it comes to sentiment. We're at 66, where we had been at 64. The 75 level, that's when we get concerned. That's when folks are getting a little too exuberant about things, and we consider using that as a contrarian indicator, but we tend to go with it if positive, as long as we're not extreme positive or negative. If it's going up, we tend to roll with that too. Our trend is positive, and we do have a confirmed trend in the short term, but we don't have a confirmed trend in the intermediate term yet. And I'll show you those charts. With the update, our bias is positive, and our momentum is also positive over the last 2, 3, 4, 5 days taken together. So we did get the FHFA housing price index. It came up 0.1%. Last time it was unchanged. The Schiller case home price index was at 5.9%, less than the 6% they thought was going to come out. Last time it came in up 6.5%. Consumer confidence actually came down. It came in at 98.7. The last time it was at 102.9. Excuse me, they expected 102.9. Last time it was at 105.6. Okay, so here's a chart of the FHFA house price index. It still shows that housing prices are going up. And here's the Case-Shiller home price index, also going up when we look at here on a month-over-month basis, but it's actually coming down when we look at this on a year-over-year basis. Here's consumer confidence. The blue line is the reading that we just saw here. That's how they calculate this particular economic report. Actually came down a little bit. And then when you look at the purple line, people are not feeling really good about things right now. It could be apprehension ahead of the presidential election and all the elections that will be happening, and a little bit of a tick down when we look out into the future. How are folks feeling about that? Okay, so here is the overbought, oversold composite. We're coming in at 46.85 now after we had been up at 83.5. Actually, it's the other way around. We're at 83.05 right now, getting a little bit toppy right now when we take these indicators together. And then the equity flows, seeing a lot of money coming in to equity flows. You have a big up week, people start throwing their money into that area of the market. And then exposure to equities, just not really changing all that much, a little bit over 30% right now. And then the second longest wait for Fed cut in history. Of course, this was like 10 years. This was coming out of the great financial crisis, and then interest rates just stayed flat for many years. Well, this is the second longest period that we're seeing for right now. Financial conditions actually getting a little bit looser. That could tend to be positive for the market. And then the commodity traders, they're very long U.S. rates, meaning interest rates. They think they're going to go higher, and have been contrarian indicator when we're looking at this. So they're in a lot of these positions right now, which could actually be more positive for the 10-year yield. And then looking at what are we focusing in here, here's core PCE, which we're going to be getting in Friday's session. And then the inflation tracker here actually still has that going down by Goldman Sachs, where they anticipate it turning up here with core PCE inflation. And then they say a similar story with respect to equity price against the ISM PMI. I have a thing on my recording screen here that covered that up. So we're seeing a little bit of a negative divergence here. They have a tendency to move in the same general direction, where we're seeing the S&P going up, but the ISM PMI actually going down on a year-over-year basis compared to with each other. And then the prime rate in real terms, that's meaning taking inflation into account, was the highest this century. Okay, the century's 24 years old, almost coming into the 25th year. You can try to make it sound all grandiose and so forth, but we are seeing the prime rate actually pretty high currently, as it was right back in 2007. We're watching some other things because this is right before the great financial crisis. We're also seeing the 3-month yield really continue to drop. That also happened before the great financial crisis. We don't know if it's going to play out that way, but we don't know it's not going to play out that way either. I didn't spend any time on Twitter since I'm a tourist these days. Here's the intraday chart. We did have a higher open, but we came all the way down to 5,700, a psychological level. That set the support before bouncing back up above R1, staying above R1, and closing pretty much at the high for the session. And nothing really all that big happening in the initial overnight session. Currently, we're concerned about this with the red line above the blue line. Now, they're both tending to go up overall, and that's positive, but we want to see the blue line growth outperforming value, which is the red line. Not really seeing much of an improvement here with intraday growth to value for the S&P. It's not falling apart, but it's not showing an awful lot of strength. So our end of day charts, we were up 0.5% with large cap growth, where value was slightly down. We were down with growth with the mid caps and down with the small caps. So we look at our small cap growth to value ratio, not really showing any strength. Mid cap growth to value ratio, not really showing any strength here. Still looking okay when we compare S&P growth to value, but we want to see this continue to go up to be more positive on the market. We'll look at our growth versus value ETF. We're coming still up into the middle part of this rainbow. We want to see this go up if we're positive on the market. If we turn and go down, that would be more negative on the market. Discretionary is showing some improvement after being really disappointing in most of 2024. This is one of the better looking ratios, at least right now. Large cap growth still doing well, not setting an all-time high, but above all the moving averages. And here's our intermediate term trend, which this is the one that I focus on the most here. We're still below 20, but we're above the moving average. So we are in a trend, but it's a non-confirmed trend, and it's positive with the green line on top. This is where we're starting to see a confirmation. We crossed above 20 with the short-term ADX, above the moving average with the green line on top. So now we have a confirmed short-term positive trend. We really dropped off with volume, and this particular indicator we look at is going to be skewed for a while because last Friday was quadruple or triple witching, and that produced massive volume. And we're coming down here with the VIX. We're more in that area where we tend to see positive returns for stocks, both with the line chart and the bar chart. And we're also continuing to decline with the VIX of the VIX. We're still getting a real high reading here with the skew index. This is a variation of the VIX. It's calculated in a slightly different way. Still getting a very high reading where the market is anticipating some kind of a big move. Our charts would suggest that could be to the upside, but the Hindenburg omen and the seasonality suggest that that could be to the downside. We don't really know quite yet. However, when we look at the momentum of the VIX, it continues to be down as stocks are going up. This is the seasonality chart of the VIX, where we're continuing to go down for right now with the VIX, but typically what happens right around this time of year is the VIX goes up as stocks go down. We were down just a little bit here with this fear gauge, and we were down a little bit with this other fear gauge, so we're seeing a little bit of confirmation there. We're seeing the risk on versus risk off ratio continues to go up. If folks are buying like the NVIDIA, Google, Apple, this ratio goes up. If they're not buying those stocks, this ratio goes down. And we ticked back up just a little bit here with our daily equity put call chart. And we're starting to turn back up after going down with our 5-day chart, but we're still declining with our 10-day chart. So we're not seeing across the board confirmation there. Typically, when this is going down, that's more positive for the market. Volatility risk premium, just a little bit below this band here, also not really giving us any insight and not showing us an awful lot of fear currently. The advanced decline line is looking pretty good based on price. We didn't quite break out above this previous high based on volume, but still, they're both above advancing moving averages. The new highs are looking pretty solid right now. We saw many more new highs than new lows for the S&P, so we're going up with our 5-day and our 10-day moving average. The accumulation distribution continues to go up. We might be getting kind of far away from the moving average as measured by the boom indicator, but we were concerned about this all last week. It didn't really amount to anything. That's why we were concerned and watching it. For right now, anyway, it seems to have worked itself out. And we're continuing to be positive with the advanced decline ratio. Here's another breakout based on price with the advanced decline ratio and volume, both above zero and looking pretty healthy. This was another concern. We were starting to go down with the Chaikin money flow, another smart money indicator. Now it's starting to go back up. And the Chaikin oscillator had been declining. Now it's starting to go back up as well. We're looking better here with the vortex. So our primary indicators are showing an improvement. We're still looking good on a longer-term momentum basis with our 10-day average of the S&P highs minus the lows. And we're getting a positive score when we measure the daily version. That's the black lines in here with the S&P 500, and then a 50-period moving average continues to go up. Here's another look at that same chart where we're continuing to go up here as well. We look at the S&P 500 advanced decline line cumulative based on price. It's continuing to set new highs here, and we're also breaking out and looking a little bit better, but not quite setting a new high based on volume. We're still looking good when we compare the S&P to the NYSE advanced decline line. Then we look at a cumulative advanced decline line for the NYSE based on price, setting a new high. It's going up and not really breaking out here with the regular NYSE advanced decline line. Also going up with this other NYSE advanced decline line that's calculated in a slightly different way. Common stock on the NYSE breaking out, but not to a new high. We are breaking out here based on volume. And we look at the new highs, new lows, just the daily score is the black up and down lines here. That's positive. And then this is a 50-period moving average, also going up. So the broader market is also looking pretty good. And we look at a 5-period moving average of the highs minus the lows across the broad market, still looking good there. The advanced decline line looking pretty positive with the NYSE common stock, S&P, mid caps, and flattening out here with the small caps. We look at a ratio between large caps and small caps. This is going up slightly as folks are still favoring large caps. The stocks inside of the S&P above their 20-period moving averages did decline a little bit, but we're still above 50. So we're still above 70 here with our study. That's just showing good shorter-term momentum to the upside. And we went up slightly with those stocks above their 50-day moving average. And we're starting to get just barely extreme with those stocks above their 100-day moving average and going up, but not extreme with those stocks above their 200-day moving average. So here is a look at the daily chart. We did set a new all-time high with the S&P on a closing basis here, but we're not really breaking out to the upside yet. Down below, the moving average really kicked up. That's why we're seeing a slightly below average volume day for that measurement. We came down and no longer extreme with the 20-period moving average. We're still extreme with the 50 and 200 now. And here's our short-term indicators. The Stochk RSI is extreme positive. The Williams percent are. The CCI 14 is not extreme right now, but there should be a CCI 20 in here somewhere. Okay. It's there, and it's extreme positive. The condition of our 20-period moving average is still looking pretty solid. Here is the simple and exponential moving averages. We're seeing the blue line cross above the red line. That's showing more strength because the blue line moves faster. We're still extreme with the stochastics in the short, intermediate, and long term. We're positive with the force index. We're right on the border between the +2 and +3 channel of our standard deviations chart. So we're not extreme there. It does become extreme when we get to the +3 channel. We're still looking okay here and positive with the balance of power. The CMB composite did decline, but it's still extreme positive. Here's the condition of the 50-period moving average. We're still above the lines, and the lines are going up. The no-go is still positive with the blue bars. We're coming up to the highest high blue line here. That's positive. And the TTM squeeze is finally showing a little bit of life. And right now it's looking more positive. We're above zero and going up with the ease of movement. We're coming back up. We're still positive here with the Erin since we're above zero. We declined a little bit with the S&P McClellan oscillator, but we're still above zero. So we're going up based on price with the summation index and volume. And we turned up just a little bit with the NYSE McClellan oscillator. So we're going up with the summation index based on price and volume. This is a concern. This is what I've been kind of focusing on as one of our worry areas right now. The Swenlin trading oscillator, it's positive, but we're declining based on price and volume. Momentum, though, is positive. The PMO is going up. We're starting to flatten out here based on price, but we're still going up based on volume. And we're coming down, but still positive here with the PMOs that are rising. The buy signals are flat to slightly positive. We're starting to get extreme with those PMOs above zero inside of the S&P. We're still positive with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR, and we're just coming above this green line. Now, I put the green line on here, so there's nothing magical about it. It's just when we get in above this green area, sometimes that can be an extreme positive reading. The MACD continues to be positive. All of our oscillators are positive in the short, intermediate, and long term. And the Kopic curve, another momentum oscillator, is positive. And we're flat, but still looking extreme positive here with the Sean trend meter. We're above all of the plotted moving averages, and we're just continuing to go up with the bullish percent index. And we're in that area where sometimes this can top out and start to go down, but we're not seeing that yet. We're going up and looking solid with the NYSE bullish percent index, and we're actually declining now, but we're still positive with the NASDAQ 100 bullish percent index. We're above 50 and advancing with the money flow, turning back up with the ultimate oscillator above 50. That's positive. We're above an advancing moving average with on-balance volume. We're not really, we came down a little bit here, but we're a little bit far away from that 20-period moving average. And we're a little bit far away from the 50-period moving average, but we're still looking more positive when we measure the distance from the 200-day moving average. The RSI 14 is still looking solid, but we're starting to get extreme with the RSI 9. And this is actually showing some improvement. I was a little bit concerned as the red line was crossing above the blue line. Now we're seeing the blue line start to go up and the green line is going up. So this is actually switching back and looking more positive now. We're still looking good longer term on the weekly chart with the S&P. We're well above this R2 pivot level. And we're looking good on a trending basis with the hike in ASHI. The KEGI chart is positive. The Renko is positive. The three-line break is positive. And long term, we're still looking positive here when we measure above this red line with the 150 and 200 period moving averages. We're positive across the board with the Keller market model. And we're still positive with the commodities in the short term, but negative on the other time frames. We're still negative in the short, intermediate, and long term with the dollar. And we did see materials and discretionary. This is more encouraging now. We want to see tech and we want to see communication doing better, but discretionary improving is that's helpful. We like that. And the utilities ended up being down and staples were down slightly. These are more defensive areas. Healthcare was also down. That's a defensive area as well. And we saw a lot of positive things right at the open. Canada setting a new all-time high and a 4-year high here. I don't know how you can set an all-time high and then a 4-year high on the same day. And the S&P did set a new all-time high. We have discretionary showing a lot of improvement. We like that, both with the 2-year high and the BPI crossing above 70. Really not seeing any divergence here between the S&P weighted index and the equal weight. We came up just a little bit, but not a real big change with this ratio between the weighted S&P and the equal weight version. The Dow is now still setting another new all-time high. We are positive with the Elder's Impulse system for the diamonds. Not really doing all that much here with the NASDAQ, but not really falling apart either. kind of the same thing with the NASDAQ 100, up 0.5%, but not really breaking out. And we still have a ways to go to get back to this previous all-time high. We're still positive with the Elders Impulse system for the Qs. The momentum for the NASDAQ 100 is still positive. We were unchanged with the small caps, still not able to break out above these previous highs. When we look at the Russell 2000 small caps, we're still above 50 with the RSI, still above the 50-day moving average, and the momentum continues to be positive. We're neutral with the Elders Impulse system when looking at the small caps. The mid caps coming up kind of into the high end of the range. They were virtually unchanged to slightly down. And they've gone from being positive to neutral with the Elders Impulse system for the mid caps, setting a new all-time high with our total U.S. stock ETF. And the Wilshire also setting barely a new all-time high here. These are two broad market measures that we just looked at, this previous chart and this chart. That's looking good for the broader market. And we're not really seeing much of a change here with the staples to tech ratio. We're kind of coming back down a little bit here. We're not showing that staples are outperforming. That's what would happen if this goes up. And we're coming down slightly. That means that tech is outperforming, but we did see a recent golden cross with this ratio. The financial sector was down, but still looking pretty solid for the time being. We were up over 0.5% with the FANG index, so we're above the 50-day moving average, but we're still below this shorter-term trend line. Apple was up 0.4% above its 50-day moving average. Amazon was virtually unchanged. We're a little bit concerned about this blue line coming down and crossing below the red line. That would be a death cross for the trend. Microsoft was down 1%, but still above its 50-day moving average. Google came up to its 50-day moving average and since has been having a hard time getting above that. Meta was down a little bit, but still looking pretty solid. NVIDIA was up almost 4%, back above its 50-day moving average. Tesla up 1.71% and above its 50-day moving average. And Netflix was up 2.39% and looking pretty solid there. And we're seeing a stronger correlation in the short term between U.S. stocks and world stocks. The longer term correlation is still maintaining a fairly strong correlation there. We're still slightly above 70 when it comes to oil, and we're watching this mainly for geopolitical reasons. The dollar continues to be in a downtrend, and we were just down a little bit with the 10-year yield here, and we were down or up just a little bit here with the 10-year based on price. This is the other area that we're watching because we're really rolling over here with the 3-month yield, and that's what happened back in 2007 going into 2008. Now, we don't know if this is just because interest rates are going down, or is there something that we need to be aware of with this chart? We're not really sure right now. We're just taking this as a warning sign. And then we're looking okay, but not great with the Qs to S&P ratio here. Discretionary is actually looking a little bit stronger. We're showing where large cap growth is slightly outperforming large cap value. So the large caps, mid caps, and small caps showing a little bit of an improvement above their moving averages. We are concerned about this. The S&P to utilities ratio still continues to go down. We want this to go up to be more positive for the S&P. And we're following the 2-year Treasury yield too. Now coming down, that can be positive, but also why is this coming down? Is this telling us that there's something of a concern that could be developing? And we're also basically still coming down here with our staples to S&P ratio. We want this to go up to be more positive on the S&P when it's going down. I'm sorry, we want this to go down to be more positive for the S&P. So, and then here's the updated chart of the Hindenburg-Ullman. We have not received another spike yet. We had the initial spike on September 5th and the other one on September 12th. And we'll just have to wait to see because this was right before the COVID crash. This was right at the end of 2021. You can see it can take a little bit of time for this to play out. So we just want to be aware of this and know that it's in the background. So what's our outlook for Wednesday? We're still positive, but we do have a confirmed Hindenburg-Ullman, and we're in a period of historical weak seasonality. And this is the week after options expiration, which can be quite negative. We're going to get the MBNA Mortgage Applications Index. We get that every week, and the new home sales, and then all the different geopolitical things going on there. And then on Thursday, we're going to get durable goods. We're going to get the third reading of GDP. And then the big one is going to be the core PCE on Friday. Here's another look at the economic calendar. Seasonality, not really much here. We're neutral to positive with the Dow, neutral to negative with the S&P, and neutral to positive with the NASDAQ. But we are in that week after options expiration where we're only up 30% of the time. But we're still up 30% of the time, so we could buck the trend there. And we're still coming into some historical weak seasonality according to the Stock Traders Almanac. Wednesday is the most negative day of the week in 2023. It's positive, but it's the least positive day in 2024. This is the weak seasonality that we're waiting to see if that's going to actually develop. Here's another look comparing 2024 to 2023. And so what are the warning signs? We do have this confirmed Hindenburg-Ullman. We also have weak seasonality. We're keeping an eye on these defensive sectors. Really haven't played much of a role in the last couple of trading sessions, but we're just waiting to see because this has gone on now for a number of months. And the 5-day equity put-call ratio is now going back up. Growth to value, not really helping us right now. If anything, discretionary to staples is actually looking a little bit better. And the positive signs, our smart money indicators are looking better for the time being. The equity put-call ratio based on 10 periods is going down. That's positive. The advanced decline line is still looking good. Our oscillators and our momentum is still looking good for the S&P. The McClellan oscillators and summation indexes for the S&P and NYSE are still positive. The Swenlin trading oscillator, this is a concern to us. And I have it in yellow because it's not a primary indicator, but it's a little bit more than a secondary indicator to me personally. But we're declining based on price and volume, even though both are still above zero. The parabolic SAR is positive. We're getting extreme with the bullish percent index for the S&P. We're coming down a little bit here, but still positive with the NASDAQ 100. We're still looking pretty solid with the NYSE bullish percent index. The vortex is positive. The money flow, the ease of movement, these are all positive. The ultimate oscillator and the momentum for the NASDAQ 100 is positive. And even though it declined, the financial sector is still looking pretty good. So what's our conclusion? We are positive, but yet, I'll say it again, even though it's hard to say, we do have a confirmed Hindenburg-Ullman in the background, and we have weak historical seasonality in the background, but we're not seeing that on the charts yet. In the short term, we do have a number of indicators that are overbought, meaning extreme positive, but this could also suggest good momentum. In the intermediate term, this is where we might get impacted the most if the Hindenburg-Ullman actually kicks into gear, as well as the weak seasonality, and we are still positive in the long term since we're well above the 200-day moving average. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.